2022 will be the year of the interest rate hike. There is no doubt about that. We've seen it all throughout the world. Different central bankers are talking about their plans to increase the rate. But instead of worrying about how things are going to get more expensive, what I've decided to do is put together a video of 3 different sectors that are set to benefit from an interest rate hike. So stay tuned for that so that you can add them into your portfolio as a hedge. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. I would definitely appreciate that. First things first, let's go over a little bit of a high level as to what happens when the interest rates rise. So the Federal Reserve or the central bank acts to increase the discount rate. It immediately elevates short-term borrowing costs for financial institutions, and this has a ripple effect on virtually all other borrowing costs for companies and consumers in an economy. So what this means is that the central bank actually has an interest rate that all the financial institutions use to borrow. So TD will go and borrow at 0.25 in Canada. Now, what the Bank of Canada will do is they'll increase this rate, and then it becomes more expensive for TD to borrow money. And when it's more expensive for TD to borrow money, it'll be more expensive for you or a corporation to do the same. So that's just kind of the ideology as to what they're doing. The government is really trying to tighten up the economy and not make money as freely available as it's been in the past. They're definitely worried about inflation and where these inflation numbers are sitting at. So with that being said, that's very high level as to the background as to what's going on. Essentially, what's happening is with interest rates rising, there's a tightening that's happening. Money's going to be more expensive to get. Not everybody's going to be able to get the same amount of money. There's so many different factors that are going on. And to start right from the beginning, sector number 1 that I think is set to benefit is the financial institutions. They are definitely going to benefit the most because as they increase the interest rate or mortgages or credit card, they will be getting more profit margins. So they expand as rates climb. And really what we're seeing here is mortgage rates have been 2.5%, 3% for so long, which really minimizes the chances of this company actually making money in terms of the bank. So now that they can start raising that mortgage rate, they'll effectively be putting more money into their pocket. And the fact that as interest rates rise, it becomes harder for somebody to get money. So they'll really have to be selective as to who they choose to work with. So basically, financial companies are the first. In the US, you have your JP Morgans, your Bank of Americas, your Wells Fargos. In Canada, we have BMO, TD, Scotia, some of which have a great exposure, not only in Canada, but countries throughout. So those are definitely some good areas to take a look at, and especially with the dividends that they carry as well. We had a video that we talked about before about how these companies are going to be increasing their dividends like mad because of the fact that the government kind of withheld them from dispersing that money. Now they're going to be returning some of that money that they've saved during the pandemic as dividends, returning them to the shareholders. So this is definitely one area within the financials that is set to benefit, but we also see here that insurance companies will benefit as well. And the high level on that is the money that they put aside in case of any accidents. They actually need to put them into safe investments. So they need to put them into things like bonds. And what we've seen with interest rates being so low is that a bond yield or the bond interest rate will effectively be just as low. So they're not making as much on their money over the past 10 years. But now with the interest rates rising, we should actually see the bond yields start to increase as well, and they will effectively make more money on their money. So that's definitely one area to look into. Manulife, Sun Life Financial. I'm not sure who the players are in the US, but that's definitely an area that I would look to. The third area within the financial institutions that definitely piques my interest is the credit portion of it. So Equifax here, if you're not familiar with Equifax, it's a credit data and analytics provider, and it's one of 3 national credit bureaus that are effectively gatekeepers on all consumer lending. So like I said, with this tightening of the economy, it will be harder to get money, and you'll have to prove more to the government or these companies that you have the capacity to pay it back. And how do you do that? With your credit score. So companies will be relying on Equifax and some of the other players in this space to ensure the money that they're lending out will get paid back. So that is definitely the financials in a nutshell. If you don't want to pick a winner, maybe find an ETF in this space. We've talked about HCAL before. It's a play on the big 6 in Canada, big 6 banks, pays a very healthy dividend. And definitely the way that I would play it if I didn't want to go in and pick an individual company. So that's sector number 1 in a nutshell. Do some more homework on that and see what else you find. The next one that we need to talk about is consumer staples. Now, what is that? Consumer discretionary. And they are basically the stuff that we consume on a daily basis. So you have a company like Pepsi, food and beverage. You have Coca-Cola, obviously the main competitor there. You have dollar stores, Dollar Tree in the US, Dollarama in Canada. This is stuff that we're going to continue to buy no matter how expensive it gets, because A, we need to eat, and B, we need the small little knickknacks in order to get our life moving forward. So they typically perform best during peak times of the economic cycle and during early stages of rising interest rates. But non-cyclical or defensive stocks are more suitable before recession hits, which is difficult to forecast. People still need housing, food, heating, cooling, education, and products for daily living. So look into food, which you talked about, Pepsi, Coke, definitely 2 great areas to look at. Heating, cooling, we're talking about utilities, and education as well is something that'll never go away. So take a look at that. There's definitely some ETFs that can give you exposure in that sector. The third, and probably my favorite, is healthcare. So just like staples, people need to buy their medicine and go to the doctor in both good times and bad. You can play this by a few different ways in Canada. I played this through HHL. It's a Harvest product. They write covered calls. It's not the best for a bull market, but it's definitely something that I like in terms of the yield. We also have ZHU, which is a BMO product, a healthcare ETF. And then we have XHC, which is the iShares product of the same. So look into those a little bit and see if any of those strike your fancy. But basically what we're doing is we're saying, hey, we're at the peak of the economic cycle. The banks are starting to tighten. Money's going to be harder to get. What companies do we want to be in case there is a potential downfall? Now, healthcare has its other cyclical trends in the background with the aging population. Consumer staples are cyclical, non-cyclical. There's no time period where that wins or loses. And, going back to the financial institutions, obviously those companies in Canada have been performing very well since eternity, really, as far back as we can look. So those are 3 main sectors, areas in which I see winning if interest rates continue to go higher over 2022 and beyond. And if you're still with me, I hope you enjoyed the video. If you're still here, hit that like button. And I hope you all have a great week in the markets. Happy trading.